Discussing Tesla Q4 earnings. We had a call last week. We had a conversation with the company. So this is the discussion now. I think I want to talk about three big picture things. One is the more short term, which is thinking about how the next couple of quarters might evolve in terms of volume, sales, and margins. Then a little bit more long term, what we think about FSD and AI, and the last thing, generally corporate, and in particular, what we think about Elon Musk and the leadership and how the company could potentially be restructured to be more effective in following its mission. This is not in the wrong podcast. It's January 31st, 2024. This is Krim Delco. For the day, we're up 35 basis points. The market's down 20 basis points. For the year, we are down 18.5%. The market's up 3%. We're underperforming by 21.5%. So Q4 earnings last week came in. The stock has sold off. We discussed some of that already. I think this venue here, the Not Even Wrong podcast, is not a news channel and also not really a stock analyst channel or anything like that. So we're not going to now analyze the company like maybe a Wall Street analyst would do or one of those YouTubers. And there's plenty of resources for people who are interested in that. The purpose of the Not Even Wrong podcast is to give people a sense for what it feels like to run a hedge fund. That's why we're here. We've been doing this now for this is the fourth year. We're finishing the third year and going into the fourth. So I hope we've been able to garner some interest. The fundamental idea is to really reflect sort of maybe on a diary basis, what's going on, not daily, but kind of diary basis, and hopefully share our thoughts in a way that help people navigate their own situations. This is not investment advice or anything like that, but hopefully there's some parallels. So in this particular case, we are exposed to what we call artificial intelligence and real-world AI. So why are we distinguishing those two? Because there's quite a difference between what the community considers artificial intelligence as we speak and what we are mostly interested in. And the difference is really in the embodiment. And embodiment means that you can have intelligence in form of Google or ChatGPT. That's not embodiment. That's not physics. Or you can have intelligence in form of a car like a Tesla or an Optimus, and that's physics. That's the difference. Most of the technologies are relatively similar. Not exactly the same. For example, in our opinion, reinforcement learning is paramount in robotics versus in these other technologies. It's there, but not paramount. So there's things like that. But we're going to talk about this actually probably in a follow-up episode today as part of our embodied series. AI for embodied agents. But now this is an earnings call discussion. And we're going to start with the first, which is sort of the near-term outlook. So our conclusion is that Tesla has decided to not push volumes anymore and stabilize pricing and improve margins. This is our conclusion. And therefore, I would say this is something where everybody is negative about their earnings call and the way they phrased it, but in fact, it's a good thing. And whether they did it on purpose or whether it's a miscommunication, that remains to be seen. But after talking to the spokesperson at Tesla, we believe that that's really, the way this conversation, by the way, has gone is we usually, when we talk to, let's say, investor relations people, we try to reflect our thesis on them and then let them decide and say, well, you're kind of on point, or no, you really aren't. So in that case, so we're not asking questions like, okay, what's your guidance for this year or things like that. We don't ask anything that they haven't communicated already. But what we try to do is really reflect our own thoughts and make sure we're on the same page. So what we believe is that they've decided not to push volume. They've decided to stabilize prices. That doesn't mean they're not going to go down. It doesn't also mean they're not going to go up or anything like that. Stabilize just means that because you're not engulfed in this necessity to grow, let's say 50% or 40% or something, which is quite a bit of volume growth. Because of that, you have the liberty to essentially price your offering based on demand that is, let's call it natural. And what we call natural demand is really people wanting the car. And the reason Tesla has gone from 20,000 cars to roughly 2 million cars in a span of less than 10 years is because the Tesla is a much, much better offering on several dimensions. As a transport vehicle, as a technology gadget, as a cultural icon, all that kind of stuff ties into Tesla just being more desirable and therefore able to sell more cars. But there is a natural demand for these things. And let me try to elaborate that a little bit. This is, we've spoken about this a lot, me and my partner, after the call. There's kind of, let's take another example, which is sort of Whole Foods and the organic revolution that started maybe 25, 30 years ago in the United States, right? So you have this little grocery company called Whole Foods. And by the way, they did not invent organic food by any means. What they invented is make organic food cool. That's what they did. And it worked really well, and it created a huge following in what I would call urban settings around the United States. Now, there is a certain natural demand for that stuff, and the company was growing, I think, roughly 15%, same-store sales growth, that kind of thing. We've been invested for years, so we've been digesting their comps and all that. But what happened is that they did kind of stall at some point. And a lot of it is maybe unforced error, not their fault, whatever. But I think there's a certain natural demand, people who want this. And then there is a big, big mass of people who are interested, who sometimes buy, sometimes don't, and most importantly, who are absolutely indifferent whether they go to Safeway or Whole Foods. And that's kind of the same with Tesla. And what I mean with that is that there is a certain stock of people who want Tesla because it's a better product, because it's a more interesting brand, or it's because they associate Tesla with something, let's say, decarbonizing energy, with entrepreneurship, Silicon Valley mindset, those sort of things. I mean, it's not a wonder that we have a much higher penetration of Teslas in Silicon Valley than anything else. There's certainly, than anywhere else, there's certainly some sort of, cultural bias towards that kind of product in Silicon Valley versus in Connecticut, there isn't. So there's a natural demand. Now you can push that with pricing, but what I think happens is when you push prices too far down, and I call this the Marriott effect. People that stay in a Marriott, they are comfortable with a certain level of service. And Marriott is very, very good at that. So they give you basic service, safety, clean, all that stuff. But quite frankly, it's not cool. It's not really nice. It just does the job. You're a salesperson in the middle of Iowa. You need to stay somewhere to do a call next morning. You're not going to ask a lot of questions. So people like that, they're not very discriminate. They don't discriminate. So if you give them, a Ritz-Carlton room with, the nicer amenities and just everything feels nicer, or you give them a Kimpton or some boutique hotel or something nicer, and you price it a little higher, they're not gonna care. Even if you do it at the same price, they might not care. And here's the punchline. Even if you do it at a lower price, they still might not care. They just simply don't care. And even worse, if you do lower the price and they go to your place just because it's cheaper, that's what I would call a bad customer. they will become, problems. They might, they're just going to create problems. This is sort of the way we think about Tesla. So lowering prices to get that next level of customer is not worth it. You're better off with a next gen product that targets that segment, because it's still going to be a product. Maybe, you're going to buy something for $35,000 that really should be costing $50,000. So it's still going to be a much, much more compelling product relative to a $35,000 car. But it's not going to be a Model Y that really should be priced at $50,000. So this is kind of the way we think about it. And the positive thing about this is that now we're looking at a potential 15% volume growth, 25% sales growth, and 30 to 40% earnings growth. That's the positive. Yes, it's coming off a relatively lower base to what Tesla could have been doing or was expected to do based on the banner years before. But doesn't matter. We printed $3 a share. We could go to, let's say we do 2.1 million cars. We have an ASP maybe north of 50,000. So we go way above 100 billion in revenue. We have maybe 20% gross margin, so 20, 22, 21 billion. We have, in gross profit, we have SG&A, and we're looking at maybe high threes or maybe even a 4 EPS. Now there's a tax thing here that might suppress that a bit, but we could have, apples to apples, 30, 40% growth in EPS. That's the upside. It doesn't justify 100 times multiple, but it's still, it gives a base to the stock. If we can do $4 at 40 times earnings, which, by the way, if the company grows 40% earnings per share, it would be on the low end, then we're already at $160. Now, certainly, we think it can be a higher multiple, but we're looking at a company now that is priced relatively safely. So this will be our first, this is the first thing we would like to say. The second is now FSD. What do we think about AI and FSD? This is the bulk of our work. This is what we've been spending our time with, I would say, more or less in the last at least 6 months. Our focus has been on AI, understanding the science, understanding the technologies, and we're getting there. I attended a seminar yesterday in Zurich here, Michael Bronston, talking about GNNs, graph neural nets, and things like that. Not exactly relevant to robotics, but still interesting. Anyway, let's get back to the AI side of things. So the way we think about FSD is that I think V12 is certainly not an inflection point yet. It's too early to talk about inflection point. But what V12 is, by the way, that's version 12, which is the end-to-end learned or fully stack optimized algorithm that helps Tesla drive around. So it's not an inflection point. What do we mean with inflection point? What we're looking for is higher adoption or monetization of FSD, higher margins for Tesla through software. This hasn't happened yet. I think that would be a massive re-rating of the stock if that happens. So for example, if we have a couple of earnings calls or let's say a fiscal year where we're looking at, let's say, 20% automotive gross margin, and then they have another 2% software margin, so they bring in 22% gross margin, and they have an operating profit in the teens, a margin, then that will be a re-rating of the stock in terms of multiple, but much more importantly also in terms of perception of the stock, which of course translates into a multiple. So that is what we're waiting for as investors. We have in our sum of the parts about $150 for the car business. We have $180 for the, actually $190 even for the FSD. And that's because we priced it miles cost per mile. And if you add FSD and FSD works And even if you still drive, even if you still need a driver, but the cost per mile can go down dramatically simply because you're going to drive a lot more miles. So what Tesla has to do, what Tesla has to optimize for, is to make a car that can go many, many miles. And it can do that by making it high quality, but also by making it easy drivable. And that's what FSD does. So in both ways, look, if we don't have a robo-taxi, maybe the 190 gets halved into 90, but we're still looking at quite a bit of value coming from FSD. And we're incredibly excited about it. It's the best real-world AI company out there, but we don't have a clear line of sight when that will translate into monetization. So the good news is that when FSD is now deployed, whether it's for real or for shadow mode, which I'm going to discuss in the follow-up episode. Actually, I think I have to explain shadow mode because that's really important. That's part of the reason why Tesla is ahead of everybody else. So because of that, we have continuous learning, and because it's now a full stack optimized solution, we can we have a much more scalable algorithm that can grow into hopefully a solution that works fully FSD, so full self-drive. You know, whether the regulators force you to still drive and hold the steering wheel, that might happen, and that's okay. But the technology is certainly available, and you know, within the next maybe 1 or 2 quarters, we expect to see at least the narrative to start circling around. Okay, V12 is good enough. We can deploy it more into more people. So the key, what we're looking for mostly, is to see monetization translate into the P&L. So again, like we could have a narrative, for example, that says something like, well, V12 is really good. I think I want it. Like people asking for it. Tesla offering maybe a better price. Right now, they don't have an incentive to actually push it out to as many people as possible because it's too risky and they don't want bad headlines. But that will change. And that point might come in maybe 6 months, maybe a year, but it will come, and it's worth waiting for that. That's definitely worth a wait. So the third thing we wanted to discuss is what we call corporate general restructuring. So first, let the big 100-pound gorilla come out. We're expecting Elon Musk to announce some sort of retreat from his CEO position, and you know, he could pull what we call a Larry Ellison, which is he can be chief architect, he can be chairman, like for example, I think Starbucks has that situation with Howard Schultz. I think Gates was chairman for a long time. You know, Reed Hastings at Netflix. So we've seen that before. I think it would be very, very good for Tesla because right now we have a problem, which is the boss, but he's not there and he's not in it. Musk is not in it. That's worth a whole other episode why we think that, but he's just not in it. And it's very difficult for people under him to work when they still have to report to him, but they know a lot more about the business. They know what we mean with not in it is, look, there are, let's say, 2 types of problems at Tesla. There are the exciting problems, such as changing the production technology for next gen, FSD, you know, thinking about what kind of new algorithm FSD could maybe implement to solve certain problems. Those are exciting problems, and I think that's the kind of stuff that Musk still wants to work on. However, thinking about pricing in China, thinking about how to deal with interest rates in the US, thinking about how to counter the German car industry's FUD campaign in Germany, in terms of, you know, the Teslas aren't good quality and blah, blah, blah. That's for other people to do. That's not Musk's forte. It's much better to hire professionals, even MBAs, people like that, professional people, marketing people, pricing people, planning people, whatever. Those types of people, they have a lot more. They have a lot more skin in the game when it comes to solving those problems, and for them that's their livelihood. That's not just their you know, they have to do it on the side because they actually are this visionary super CEO that has no time thinking about interest rates in China, or what's the real estate market doing in China, or all that kind of stuff. So that's kind of the way we see it. So we're positive about the potential retreat. We also think that the company has to deal with another problem, which is what we call hiring. And what that means is simply, look, the AI people in Tesla, they're facing a problem, which is if you're a top-notch AI researcher now or engineer, you can go work for Anthropic or OpenAI or even NVIDIA, maybe not NVIDIA, but you can go to one of those startups, or you can even join one of the thousands of little startups that is doing, I don't know, changing the way insurance companies deal with interaction because of ChatGPT, or banks, or those kind of startups that, the acqui-hire types, where they go in there and they work for a year and they hope to sell their little startup for 100 million to JP Morgan, cash out, and then start a new startup. Like those types of people, they're often they're not really suitable to work at Tesla, but there is an overlap, and it's really hard to get those people. And unfortunately, you need those people. You need top talent. AI is new, it's fresh, and it requires creative, risk-taking, aggressive, interesting people. People like Jitendra Malik, maybe not anymore, but certainly was 20 years ago, or now Sergey Levin. Those types of people, maybe not them themselves, they should stay in academia, but their disciples, people who associate with those types of people. They don't care about accolades. They're happy to change, like Jitendra went from, differential equations to neural nets, and gave up almost the whole career because he saw where the puck was going. Those types of people, they need to go work for Tesla. This is an appeal to those people. Go work for Tesla. The problem that Tesla's solving is how to make a robot that drives like a human-like driving. By the way, this is just a side note. The investor relations person actually mentioned that, which is very, very exciting. When I asked about V12, he said it drives like a human, which is, we stated that in our episode about problem. The problem statement of Tesla should be, it should drive like a human. And by the way, one more thing that he said, which is incredibly positive, which is that the game in Tesla AI at this point, at least for the car, it's all about compute. And this is really important, because that means Moore's law is kicking in. That means that we can actually get results very quickly because Moore's law works. So to summarize, let's summarize the sort of the corporate side of this conversation. We believe that Tesla can have a bit of restructuring. We believe that it will be actually very beneficial for Tesla to have more dedicated leadership and to separate sort of the visionary stuff from the day-to-day stuff. And Musk can be chief architect, chief product officer, and delegate to other people. There's enough bench there to deal with that. And to summarize the whole conversation, so we spoke about three things: short-term sort of margin, sales, and volume growth. We believe that Tesla is stabilizing volume and pricing. They're going to grow, but not as much. We expect ASPs to be stable, if not a bit higher. So we expect a little bit more sales growth and volume growth, and then we expect a lot more earnings growth, because just, for example, if Cybertruck can exit 2024 with a net gross margin, not losing money on the gross margin side, then that's already about 2 points in gross margin probably for the company. And then maybe some FSD accretion can start happening, which leads me to the next point. FSD is, we're not close to an inflection point yet, but there is potential for an inflection point where the adoption of FSD can increase, because now the end-to-end learning helps improve much faster. And third, the corporate side of things, we believe that a restructuring of Tesla into a sort of a creative and a day-to-day type business, where Musk goes to the creative side and leaves the day-to-day business to a CEO or a COO like Len Shotwell at SpaceX, and runs the day-to-day business, that would be very, very beneficial for the company. Thank you.